In this lecture, we are going to look at the issue of strike prices. So let's come back to our Netflix trade. We're going to put a bear call on Netflix. And what I want to do is go out to the April series, which has 57 days to expiry. So once we go there, and before you go there, what you want to always have an idea of is where is this one standard deviation range when it comes to putting on a credit spread. So whether it's a bear call spread or a bull put spread, you want to have an approximate feel for where the one standard deviation line is, because you want to put a mental marker there. And that's going to help you with your decision making ability as to what is the probability of Netflix hitting these strikes. So the Thinkorswim platform does this automatically for you. So for every series, you will see a plus or minus number. And I'm guessing other platforms should be able to provide this information as well. But regardless, on Thinkorswim, for next to every series, your standard deviation is calculated for that series. The standard deviation number is a function of the stock, its price, and the volatility, and also a function of how many days are left to expiry. So Thinkorswim automatically calculates this number for you, and I'm assuming that every other platform also does that. So every expiry series is going to have its own plus or minus range for the one standard deviation number. And this is not a linear calculation, so you won't be able to find a pattern that runs common to all of these expiry series. That's because standard deviation calculations involve the square root of time. So that makes it a difficult calculation to follow. But regardless, we don't need to worry about all of that. What we really need to do is look at the April series and say that this has got an approximate $33 plus or minus as its one standard deviation range. So immediately what we need to do is to add $33 to our stock price. And if we do that, that comes to about 215 or 216, 217, somewhere there. So a good practice or a best practice would be, to be safe, you would put it just outside the one standard deviation range. So let's say we choose the 220. Then this has a delta of 22. And so it's got a 22% chance that Netflix is actually going to hit the strike. Now, again, this comes to personal preferences and personal situations. If you have the time to watch the markets, then perhaps you can come a little closer because you're watching the markets, and if Netflix starts to make a big move against you, then you have the time to react, you have the time to plan your adjustments, and you can do it in a very comfortable way. But if you already have a day job, you don't have time for the markets, and you want to be safe with your spreads, you go out a bit further. You can go to like a 14 delta or a 16 delta. I would say go, if you don't have time, then you really need to go between a delta of less than 15 and probably around between 15 and 10. Now, you're obviously going to get much less premiums for this, but you will have much less to worry about as well. And that's really the trade-off that you're making. If you go further out into the strike prices, obviously your credit is going to be less. But on a $5 width, even if you pick up 50 cents or 60 cents, you've got to understand that this is a monthly income strategy, and you've got to craft your monthly income strategies based upon certain return numbers. So if you look at it, even 50 cents or 55 cents, that works out to be about 10%. And even if you capture only half of that, because we don't plan to hold this trade until expiry, we plan to hold it for about 30 days. So even if you capture 25 cents out of that, that is a 5% return that month. And that's obviously a fantastic return. Now that return might vary. It might be 6% one month, 7%, or maybe even 4% or 3%. But that's a return in 1 month. And the goal of creating or using credit spreads to create a monthly income is exactly that. you've got to be able to generate about 2 to 3% a month based upon how much capital you put. So in this case, we put 5,000. But everybody's account size is going to be different. You could have an account of $100,000 or $1 million. We don't know. But so put a contract size that is appropriate for your account. Do not increase contract size unless it's absolutely required or your account can handle it. So this is again a personal characteristic that you'll have to manage, because one of the things that can hurt your trades always is size. Size is very, very critical. So do not exceed a normal trade size for your account. But the point is, even if you pick up 50 cents, you're putting close to about 80-90% probability. So think about it this way. You're picking up 10% of your margin amount, right? You're picking up only 10%. But what do you have going for you? So if you had chosen the 240 or the 245, you've got probability going for you. So you've got a 90% chance of success on this trade. And that's exactly what it is. You're picking up only 10%, and that's because you have a 90%. If you pick up 15%, you'll probably have about 80 to 85%. If you pick up 20% of the credit, then you're probably looking at between 70 and 75. So that's the way you have to look at probability. That's the way you have to look at how much credit you're getting. And that's the way you have to select your strike prices. Most importantly, you have to remember, if you come closer, you're going to get more credit, but you have to be aware that you're going to have to adjust your positions much quicker than otherwise. So it's a personal choice. You can come closer to the stock and you'll pick up better premium. You can even, let's say, for example, Netflix is at 184, right? So let's create a spread that is at 200 and 205. You can see you're going to pick up $1.50 out of the $5 spread. So that's 30%. You'll pick up 30% credit. But what are your chances that you won't have to adjust? I don't think it will be very high. Here's your 200 strike. It has a delta of 0.39. So it has a 39% chance that Netflix is going to hit this strike. And most importantly, it's not about whether it's actually going to hit it or not. What's really important is this white line. So as it comes down, you're going to see that not only are you hitting the short strike, but your losses are also accumulating faster, because now you're going to have, you just have a more intense position here. And that's what you have to judge and decide. As a general case, I would say always stick to less than 20 on your short call. And if you can come down to about 15, that will actually be better. That will keep you in the trade. That will keep you from over adjusting, and you'll see that that's a very comfortable zone. But if that's also too intense for you, go down to a 10 delta. That's fine. You're going to pick up very little premium. You're going to pick up probably 10% or less of the spread, but you have a 90% chance. And most importantly, you won't have to worry about your positions because your personal situation keeps you busy during market hours. So that's how we look at strike prices. Now, in the next lecture, I want to look at how we chose Netflix for our trade and what was the technical analysis reasoning behind it. Thank you.